Hi, this is Charlie giving you Wednesday's brief update, and I'm going to talk about the pound today and the flash crash from last week because I didn't get to talk about it whilst we were doing the live trading last Friday. Before I do that, obviously tomorrow night, so that's Thursday, doing this swing trading webinar, and we are already oversubscribed, but you can carry on subscribing. So all it means is that just make sure you get logged in nice and early tomorrow, so a good half an hour to an hour early. I would advise logging in so that you make sure you get your seat, because we are oversubscribed for it. You can carry on over subscribing, so the system will allow you to do it, but then on the night it's more like on a first come first serves basis. So that's all I can say about that. The link is below on this email, below somewhere on the email. As far as the pound dollar is concerned, and most of you have read all about it, so I'm not going to talk about why and what happened. All I'm going to talk about actually is the realities of when we're trading with these sorts of things. Because Kim and I get emails and inquiries come in from people saying, this is what happened to me during this moment or whatever. We get emails from people on a regular basis that we about all aspects of trading. And what's been interesting here is that obviously the pound's showing a low down here about 120. The realities were some brokers were quoting sort of going down as low as 112 because they were getting some orders down there. But what we're seeing is anyone who was long cable, and it doesn't matter, you can argue, well, why were they long cable or whatever. There's always an opinion on, and there could be people who were long the market that night before, based on intraday charts, which might have been given buy signals. And so there will be all sorts of reasons. But some of those people will have got stopped out with a good amount of slippage. And what I'm hearing that some people have 200 pips of slippage, and then I'm hearing other people 400 pips of slippage. And so the point I'm trying to make here is, if you're using a spread better, you have different options. One option could be you might say, do you know what, I'm actually going to start using guaranteed stops if I'm swing trading. If you want to, you can use those. You have to pay a little bit more for it, but you might say, well, I'm getting peace of mind or whatever by using guaranteed stops. The other factor is, look at who you're trading with. You may be trading with the biggest broker that's got all the fancy bells and whistles on their charts and everything else, but funny enough, though, that's the broker who's slipping people 400 pips. Yet ETX, our preferred broker, everyone was suffering slippage, but they only suffered slippage of 200 pips. So you then have to say, well, actually, this has cost me a fortune to be trading with this broker over here, when Charlie and Kim have always been advocates of ETX. And there's all brokers have their strengths and weaknesses, but that sort of slippage has only got to happen once a year, which hopefully it doesn't even happen that often. But that happens once like that, and it costs you a lot of money. And I do hear about these brokers who slip on a regular basis to a larger extent. Now, slippage happens in the markets. It's part and parcel of trading, no matter where you're trading. But certainly some spread bettors are worse at slippage than others. So that was a really good example last week of why Kim and I still are advocates of ETX Capital over and above. There's plenty of other brokers out there. Don't get me wrong, I'm sure there's other spread bettors who are fine, but they're who we know and they're who we trust. And so I think it was a good example of that with the slippage issues that took place there. But certainly outside of that, if you are trading and you might say, well, I don't know if this is going to happen again. Nobody actually knows whether it will happen again in the markets, but obviously the potential is there until some sort of regulatory rules come in about how brokers are allow orders and trades to come through their systems. So you might say, well, I'm going to put guaranteed stops in. That's absolutely, and that's fine if you want to do that. But outside of that, I don't get the opportunity to have guaranteed stops because I trade directly into market. So I don't have that option anyway, and so I just see it as part and parcel of trading. So, for example, if you were in a trade with a 100 pip stop and you ended up getting slipped 200 pips, slipped another 100 pips, so you ended up with effectively a 200 pip stop. And as long as your risk management's okay, then if you've got for argument's sake, 1% or so at risk, then it becomes a 2% trade. Yes, it's not nice, but considering how often that sort of thing happens, it's very rare. So again, look at your risk. I will leave that with you. Look forward to talking to you properly about swing trading tomorrow.